In a clear signal of its continuing hawkish stance, the U.S. Fed Reserve not only raised interest rates to a 22-year high, but also signaled that at least one more hike is on the cards. Despite inflation falling to 3.1% in June, the Fed is taking its 2% target very seriously, seemingly unmindful of the collateral damage to growth rates across the globe.
The U.S. Federal Reserve raised its benchmark interest rates by 25 basis points to 5.5%, the highest level in over 2 decades, as it continues to ramp up its fight against inflation. The Fed has raised the interest rates now at their highest level since 2001, 525 basis points since March 2022. Addressing a press briefing after a 2-day meeting of the 12-member Federal Open Market Committee, which decides on interest rates, the Fed chairman said there could be more rate hikes ahead.
Between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index, and lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted, and I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
The U.S. Fed chair added that while inflation had moderated somewhat since the middle of last year, when it hit 9.1% in June, it was still above the central bank's target of 2%.
We'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2%.
The Fed chair also admitted that the U.S. economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring and inflation. This admission comes just days after the IMF expressed concerns about the effect of increasing interest rates on world economies.
Monetary policy is already taking a chunk out of economic activity. We're seeing the increase in interest payments. We're seeing the contraction in lending. We're seeing signs that the economy is cooling off, and that's going to help bring down the sort of underlying inflation pressures back to central bank targets. So it's already had some effect and will continue to have.
In the U.S. alone, a survey has revealed that over the past 12 months, 61% of Americans have been negatively impacted by rising interest rates resulting from the Fed's rate hikes. In the first quarter of this year, the household debt balances set a record high of more than $17 trillion. Bureau Report, Business Today Television.